What's going on, guys? In this video we're going to go over a complementary technique that I use in conjunction with the volume lessons that I've been giving to you guys, and it's about how transitions in the market occur, and how I trade them, and the different patterns that I look for. And I'm going to try to save you some money by not getting chopped off when we start getting into an accumulation phase or a distribution phase. So stick around. Alright, so let's start off with the four phases of the market. The first phase is the accumulation area. This occurs usually after a downtrend, and it's a very choppy zone where there's a lot of false signals, and it's where moving average players get completely chopped off, and it's where some traders that choose to use oscillators can somewhat make good results for a short period of time until the phase ends and we go into the markup period where their oscillators would mark as overbought and would stay overbought for the duration of the uptrend. This is why I don't use either moving averages or I don't use oscillators. I do know in what phases to use which, but after several years of trading, at some point you learn that the fastest way to make money is to be first, and the way to do that is to not use any indicators and to use price action. Price action is king. Anyone that's been around for more than 10 years in trading will tell you that. So second phase is the markup, and after that you enter into the distribution area, which is the opposite of the accumulation area. So basically smart money is going to accumulate positions in this zone while the newbies get chopped off, this is at the point where if you go on the trading view, it's at exactly that point that you're going to see the chat say, oh, BTC, we're going to 5K, or we're going to 1K, or this is over, you know, this market is completely done with, and blah blah blah. And then they start selling on 100 leverage, and then they get completely butchered once the trend starts to reverse. And then the opposite is true over here. This is when everybody gets in, when your uncle and your grandmother starts to buy Bitcoin, and then this is when they get completely annihilated. This is a 20K area that we've faced in the past December month. So now in this zone, smart money is long and short in most cases, because it's a very choppy zone in many cases, and there's a lot of money to be made if you understand the way that the waves work. And then after this overbought period, you enter into the downtrend, which is called the markdown. So you have accumulation, markup, distribution, and markdown. These are four phases of the market that you need to understand. They don't, of course, everything is not so clear cut once you start trading with the real charts, but it's important that you understand this principle and these four phases before I move on to the next slide. Alright, so let's get a little bit more technical. In the phase of accumulation here, it's important to understand that this is a phase where the smart money is A, getting out of their shorts, and B, accumulating positions on the long side. And the problem with being a big fish, or being a whale, as we call them, is that you need to have large orders filled without ringing too many bells to tell everybody what you're doing. And in order to do that, you need to go hunting for stop losses. And the way people place stop losses, they usually place them, they trace a range, and then they're going to place their stop loss right at the last low if they want to go long, for instance. And this is where the what is called the spring which also is called the bear trap. Um, Again, I come back with TradingView because I just joined TradingView. I wasn't using that at all in the past, and it fascinates me to see the level of noobishness that there is in that channel. And they call everything a manipulation. Everything is a bear trap or a bull trap. You know, retracement is a trap, and everything is a trap, you know, basically. But if you want to learn the correct theory behind price action, it's important that you understand this specifically. And the spring is that trap in technical analysis where you have some sort of a range or an established low or series of low. Here there's only two, but there can be three or four sometimes, or just one swing. And then once a lot of positions are installed over there, then they're gonna bring the price down, they being the whales or the market makers. And then once the lows are broken and the stop losses are triggered, they're gonna buy into the selling action caused by the triggered exiting of the trades that were on the long side by the small fish or the retail traders. And this is where they go long, basically. So, and then after the spring, you have you come back. This is a very simplified version of price action, but it's important that you get the drill. So here we have the stop loss trigger, then the price goes back on the upper range, it penetrates it with the breakout, and then there's a throwback or a retracement to the newly found support, which was previously a resistance. And from here on, and this is the, by the way, the SOS zone. Usually it's sometimes very choppy. Sometimes it makes some sort of a pennant formation or a flag, but it's a series of small waves usually. And it's a test basically to make sure that the foundation, that bedrock, which is the accumulation phase, was successful and is reliable. And then from here on, you're going to have a series of higher highs and higher lows, and you're going to have some reaccumulation periods, which are often called flags or pennants. The shape can vary, but the idea is that price action becomes very, very tight, and at some point the price breaks out of that again, usually in the same direction as where it's coming from. So this is why a flag is considered a continuation pattern, although there are exceptions to that rule, because there's a lot of randomness in price action sometimes, or changes in supply and demand that are based on fundamental news or large events that happen in real life. So, and then from here on, you're going to have higher highs, higher lows, and so forth until we reach a distribution phase, which is where you're going to sell everything to the retail traders that are coming in late. And this is when you're going to have all the news on the news outlet, on CNBC and stuff like that, where they say, oh, this is such a great buy, you know, buy. And then the retailer who's always late is going to start buying. And then the smart money is going to sell it to them to get out of their position and get into their shorts. So let's move on to the next slide. So in this slide, which is slightly more detailed, you have the 5 phases that the Wyckoff theory goes into when you have an accumulation phase or a distribution. You could reverse this from the other side and you would have the opposite. So basically what this here, the PS stands for preliminary support. So these are lower lows basically. And then at some point you have the selling climax over here, and this is where you're gonna notice like abnormally high volume. And I've talked about volume plenty in previous videos, so I'm not gonna go back into it, but this is what I'm looking for as a first indication that we might be done with the capitulation phase. We might be starting to enter the accumulation phase, or the end of the downtrend, basically, and or the end of the downtrend. So here after that, after this high volume, you have a V-shaped formation, which is basically the AR, which is the automatic rally, which is pushed right away back up because of people, the shorts are covering, and the smart money is already starting to buy or cover and or get long, and then you have a small retracement here, which is the secondary test, and then you have another wave that goes, and sometimes this is where a lot of people are going to get tricked into a long, as this high is penetrated, and then it brings more selling pressure, and this low over here is going to be tested in what is called the secondary test, but in the phase B. So phase A is where you see very high volume and a quick run back up followed by a retracement, and then phase B is going to be where you're going to start testing the boundaries of that range, which is created by this high over here and that low. So you have basically a trading range, but you need to expect prices to go higher slightly to get people into longs, and to get people out of their shorts by triggering stops and stuff like that. And then the same thing on the opposite side. And this is usually premature. For instance, I'll show you some examples, some real-world examples of this in action, because it's not always so clear-cut, but this is more representative of how it looks like really in real life and why it's hard to trade, because it's very, very choppy. But what I want you to understand is these three lows, okay? From SC to ST to the spring, you have three lows in this case that are lower and lower and lower, but sometimes they are higher, higher and higher, or they are equal, equal, equal. So, but they're all based on the same fundamentals of accumulation, and when it's equal, it's called a triple bottom, or triple top in the reverse. But basically it's these three drives to a bottom or three drives to a top, and at this point you have the spring later on that comes in over here. So you have a low, then a retracement, ABC basically, and then another low which is slightly lower, and then a test, and sometimes it doesn't quite reach that high, and then it comes back again, and this is when you enter phase C, where you have the spring, and then you start going back into the range, test it, and it holds, and then it moves back in, and this is where the smart money starts to get in after that. A lot of the biggest fishes, the one that want to get the biggest fish, sorry, that want to get filled, are gonna start entering here, and then more smart money is gonna get in here, and then as we move up, we're gonna have the breakout and enter into the SOS phase, which stands for a sign of strength, and this is where you're gonna see all these waves, small waves. We're going to see pennants and things like that, but basically you're going to be above or slightly into that zone of accumulation, and this is the buy point, and even here it's a great buying opportunity. And then you have phase E, where you're going into the markup, the uptrend in this case. So keep in mind that this changes shapes, but what needs to be understood is that you often have a spring, but not always. The spring can be replaced here with a higher low sometimes, and this is what it looks like basically. So you do have one test over here, some accumulation, but it stays inside of that range, but it's still valid, it's still an accumulation phase, and you can get in on the break over here at a really good price. So you can be really patient in that zone, because you're not missing much. There's too much chop, and a lot of people are going to give up, because people that are waiting for crosses of moving averages and things like that are going to start getting chopped off with false signals, and they're going to lose a lot, and then they let go of it and they move on to something else, and this is when the breakout occurs, and then you have the move on the upside. So this is one theory behind the phases that the market goes into and how to trade it. And I'm going to show you some live examples later of how I actually traded it, not later than last week actually. And I'm going to also show you another pattern that I use often, which is simpler than this and which is more aggressive in the way it changes the trend, but it is equally valid and can lead to great profit in very little time. So let me show you real quick. So this is a simplified version of a change of trend, and it usually occurs very aggressively. And the way it is, it's a very aggressive V-shaped formation like this on very high volume, and then you start entering into some sort of an accumulation phase, which is not, you're never going to see that low again. So that's why you don't necessarily need to wait for another low to occur. You know, the market moves in various ways, so if you start waiting only for Wyckoff patterns, then you're going to trade very little. So this is why this one is a simple trend line break, and I'm looking for a V shape followed by accumulation and the breakout of the trend line. And ideally you want to have, for in the theory of technical analysis, you want to have your trend line connected to 3 tops or 3 bottoms. But sometimes I have to admit I use sometimes only 2, and it works just fine. It's just a little bit less reliable, but it depends on your time frame and how much you want to get, how badly you want to get into that market for other fundamental reasons. So this being said, what you're looking for is a clean breakout with a close above that trend line, and then you want to have a little zone of retracement, and you want that trend line to hold the price. And this is perfect because we have a small accumulation phase right on top. It's like a small SOS phase, basically a sign of strength on top of the trend line, and then you buy that break and then you go to town and you have a nice uptrend that follows. So it's a simpler version. I'll show you some examples, but the idea is basically the same. You're looking for capitulation, very, very high volume. Volume is your friend when you analyze the markets, and then you're waiting for a trend line breaks. Another thing I want to point to you guys is that as we had a range previously, which was really low in that zone here with the Wyckoff example, in this case the range is over here. It's higher up, and so you're gonna have some test of this previous high. For instance, you know, there's a zone here with a bunch of lows and highs, and then here you see the price, you have the breakout, and then you have the test of this zone here. This is why you need to trace trend lines, try to figure out areas where you can connect a support or a resistance line, where there's a lot of price bounces and retracements off of that point. And you see here we have another confirmation with a break above that, and then a test, and it holds, and then it comes back over here. So the entry points for me here, I often buy right here on the retracement to the trend line, and if ever it breaks, I'll just get out. But this is often a very, very high risk reward ratio trade, because you know very quickly if you're wrong. This is my first entry. My second entry is sometimes on the break of an accumulation phase. So over here I would start adding to the position. And another possibility is if you break up and you test the resistance and it starts holding and you see a candlestick pattern, which is a sign of retracement. Again, candlestick patterns are very unreliable in general, but if you combine them with supports and resistances, then they can become very powerful. So it's all a combination of different things, and then you have your uptrend that starts going up. So as I said previously, I like to add to my position. I scale in and I scale out, and this is what I'm looking for. So I'll throw a bit of money out, see what happens, and then a bit more, and then a bit more, and then eventually I become fully loaded with very minimal risk on the initial entry. So keep that in mind. The second thing that I'm looking for when there's a change of a trend is I'm looking for higher highs and higher lows. So in this case, a significant low here is this one. and you only know that it's a low once it actually breaks out of that trend line, and then it breaks the previous high. And this is what I haven't seen with Bitcoin, and this is what I was telling you guys in previous videos, where I was explaining that I did see a trend line break on Bitcoin, but we did not hold the trend line. It wasn't able to support the price as it came back to test it on a non-log scale. That is, on the log, the trend line was never broken. So what I'm looking for is a higher high, higher low, and a higher high. And this is another confirmation here that we're definitely out of the woodshed, and what we have a confirmation of an uptrend other than the break of the trend line and it holding. So these are the two ingredients that I'm looking for a change of trend. But I also trade the Wyckoff per se, and I'm going to show you an example that I took last week, and you can verify it on my trading view. So let me show you. Alright, first, before I go into the example, I want to show you this one, this little chart here. It's more representative of what it looks like in real life. It's very, very choppy, and you may have many highs and lows, and this is why it's so difficult to trade. And I'm going to show you a pattern that I traded last week, where you had this sort of descending triangle formation with a sort of a false breakup, and I shorted right here when I saw this high and a higher low, no, a lower high, I'm sorry, and then a break of that trend line. And once this was confirmed, I entered a short, and I believe it was on the New Zealand Canadian, so I'll show you that. Alright, so real life application. This is on March 15th. If you go on my account and you click on it, notice the pattern. Let's look again at this. So you have a very choppy zone, which we can see over here, very, very choppy. And in this case, it was opening up. Basically, it was becoming larger and larger, and then eventually it did sort of a breakout of that trend line here that you had, and then it came and visited these highs, and it just penetrated it just to trigger the stops of everyone that was short over here. It just triggered these shorts, so not these longs actually, the stop losses from the shorts, and so they're able to sell into it. And then you had a low established, and then a retracement, and this is the lower high that I was talking about. That's over here. Here, so you had the breakout false. In this case, it went slightly above. Sometimes it's higher, sometimes it's lower. It doesn't matter. It's the general idea that you need to understand. And then on the break of that trend line, which is right here, I shorted, and look at what happened after that. Boom, you have a nice downtrend. All right, so this is an example of the NASDAQ on March 13. I think I spoke to you guys about this, but the volume was getting lower and lower and lower and lower and lower. So that was my first indication that we were running on steam, and this is what I call basically NASDAQ running on steam. And then I saw this zone of choppiness. It was very, very choppy, and if you went on a lower time frame, this is the 60 minutes, but I went into the 15 minutes and I saw a lot of choppiness, and this is usually a sign that there's some distribution going on. So whoever went long in this zone were selling to people in this one. And then we saw that little breakup, and I was a little bit quick on pulling the trigger on this one, but I was seeing no volume whatsoever. I was highly confident in the fact that we were way overextended, as I mentioned in previous videos, and we had this little reversed hammer, like a shooting star over here, which is a reversal candlestick pattern. And then I started shorting right here actually, which is a bit early. I don't recommend that you start chasing tops and bottoms like this when you start trading, but if you've seen these patterns enough, which is basically the range followed by a high, and then you can wait for the break of that neckline over here to enter on the short side, and then what happened is a swift downside action. So this is another example. Now this is another example of the Wyckoff, and it's a bit more complicated in real life, and this is why I want to show you this example, because nothing is as clear cut and it's not always the same thing that you're going to see. That's why you need experience and you need to know what to look for, otherwise it just looks like randomness. So here we have the first part, which is the selling climax. The way to identify that is that we had we're coming from above basically, and we have enormous volume coming in, and then we have a sharp retracement very, very quick, which goes back to the automatic rally, then a little secondary test, and then we have another wave, and then we enter phase B, and then we have a second test of that low, but this time it's a little bit lower, just slightly lower. In this case it had enormous volume, so I guess you could start the count there if you wanted to, and call this the selling climax as well. But for the sake of example, and just to put into an example what I meant when I said 3 drives to a bottom or 3 drives to a top, then you have this kind of 3 waves, 3 bottoms in this case, which are lower and lower and lower in here, and finally you have the spring, which is followed by the small accumulation phase. It could be argued that it's here actually, because this is the range that we're in. It could be here as well, you know. But basically any point where we start to see pennants and accumulation, the breakout, if it holds, could be an entry point on the long side. So you had one opportunity over here to get long. You had another opportunity after this test, because if you connect these zones of these highs and lows, you can find the future zones of supports. So it broke that range, and then it tested that here, and you could do this the same thing for these other supports and resistances. So you see here you had a high, it broke out of that range, and then it tested it and it held, and then it went on the upside, and then you had that uptrend. So this is Bitcoin today. So here I see 2 distinct possibilities, and the first one is the simplest pattern that I showed you guys, which is a simple break of this trend line. And this possibly is a sort of a Gartley pattern. It's very common in people that are into harmonics. Basically, you have sort of that double top formation, and then you have a retracement. Sometimes it goes lower, sometimes it goes even further. Here it really varies, so I don't really pay attention to harmonics, but I understand the premise. Basically, this would be the phase where we had the selling climax with enormous volume in this downtrend. Let me zoom this a bit for you. So we had the climax, and then we have the automatic rally, and then we had the secondary test, and then we had this other run here which was not able to make a new high, which bounced off of that trend line. And then here what I'm thinking is that we are in let me show you in the images really quick. So we would be around here in the phase B. So if it's the case, then it would ignore this, but this is pretty bullish, this bar, but it doesn't mean anything in candlestick patterns. You know, they can reverse in your face. But what could happen here is a breakout of that trend line. That would be one indication, which would be bullish. The second one is that we continue here and we break this low ever so slightly, just to get people out and get people short on 100 leverage, like you see in these you know, trading Bitcoin and 100 leverage is a very bad idea, let me tell you that. But anyways, so here we would have this phase, and we would have a bounce, which would maybe stop before that. It would still be valid, and then a third break of the lows, which would be the spring. It could make a higher high. If it breaks that trend line, I wouldn't be surprised if it actually went just to test that trend line and then move up on the upside. But it would not be surprising either to see the price actually going through it, just to get people out and reach 5K and then move on to the SOS, which is a sign of strength. And I expect the sign of strength zone to be in the 12 to 13K area. As I mentioned in previous videos, I imagine that this is going to be very choppy. And if once we break from there, you just sell your house and go long Bitcoin, basically. And so that's two possibilities actually. It could be like, what worries me is that this was not on very, very high volume, but if you look on a smaller time frame, actually, let me show you where I got into this trade today. The first thing I did was I spotted the short over here. When we had this bounce off of it, I went short, and it did this quick rundown, so I exited. And then what happened earlier tonight, what I did is I went long. I said going in for a short squeeze, and right here I saw this increased volume. I saw that we were against that descending wedge pattern, which is a bullish sign, and I went long right here. And what happened after that is this quick acceleration. I wasn't expecting it to go as quick, but I didn't have a limit, so I'm pretty happy, and I got out because I didn't know how much time it could have done something like a pattern like this and go there slowly, but instead it just completely ate through it. So I got out of part of my position here because I was surprised by the velocity of this move. And I was seeing a lot of whales on the bid on Binance, so people were gobbling up alts and stuff like that. So I said, okay, I'm going with them. And now it's showing a sign of retracement. So this is very bearish. So I don't know if we're going to go back down to these lows, or we're going to accumulate here or make a small retracement and then go back and break these highs. If we break these highs, I'm going long big time again. I'll add to my position, and if we start breaking on the downside, I'll just exit my position that's long currently. And the other position that I took today, just to show you real quick, another example is on VeChain, where I saw a little bit of increase here of volume. We were on the support, and we had this quick run up here on the upside. I did go long. I didn't post it, but I went long as well on XLM, and I bought NEO at, I think it was $48 or $49 when I got in, and it's already at like $63 or $65 or something like that. So this is another video about using volume, using transitions into oh yeah, this is why I wanted to show you this actually. It's because you see this, this is the sort of Gartley pattern that I was talking about, and you have a bearish, bullish descending wedge, and we have the third time that it hits. And this is why I went long on this one over here. Let me just actualize this. This is why I went long here, because it's the third time that we touched that line, and threes are very important in trading. I don't know why, but it's just the way it is. And so that's why I use the principle of three drives to a bottom or three drives to a top. And all these patterns, they kind of mix in together. Like you can have a wedge into a Gartley pattern, into a Wyckoff sort of phase. So it's all kind of linked together. So you have to learn to see the signs and pull the trigger when the situation arises. So I know this was a long video. I hope it was informative for you, because it sure helps me in my trading. It takes a while to get used to the patterns, but I really think that they're what differentiates the whales from the little fishy. So I hope you enjoyed, and I'll see you in the next video. Please give this video a like and share it with friends if you think they could benefit from it, and I'll see you in the next one. Take care, guys.